Welcome to the deep dive. Today we are undertaking a pretty critical mission, I'd say. We're diving headfirst into the incredibly tumultuous market actions surrounding MicroStrategy. You probably know it better by its ticker, MSTR.
Oh,
And
yeah.
if you've been watching the financial news at all, you know this stock has turned into just a brutal roller coaster.
Brutal is exactly the right word. I mean, our stack of sources here, we're talking analyst reports from JP Morgan, Mizuho, major institutional filings. It confirms the dramatic scale of this recent fall.
It's staggering.
It really is. We've watched MSTR suffer what you can only describe as a devastating 60% wipeout from its recent summer high.
Which was what, around $456 back in July?
Exactly, back in July. And it's dropped, precipitously to trade right around $179 as of December 8th, 2025.
Wow.
It is a stunning collapse that has, sparked just widespread fear.
And crucially, this chaos isn't happening in a vacuum, right? It's not isolated.
Mm-hmm.
MicroStrategy's fortunes are fundamentally tied to Bitcoin.
Completely.
And Bitcoin itself has also seen a pretty significant, though proportionally smaller, correction. It pulled back about 30% from its peak, near 126,000.
Yeah, down into the low 90,000.
Right. So when the underlying asset dips by 30%, the leverage version, which MSTR absolutely is given its balance sheet, it just tends to amplify that pain.
Massively.
And that's what creates this really high-stakes moment we're in.
That amplification of volatility is precisely the core conflict we have to unpack for you today. When a stock falls 60% while its key asset falls 30%, it just triggers this fundamental debate among everyone in the market.
It's the big question.
It's the big question. Does this environment of chaos and fear represent some kind of irreversible, structure-threatening death spiral, one that's fueled by very real regulatory threats and internal uncertainties?
Right.
Or is this just a massive temporary fire sale that's attracting the smartest, deepest-pocketed institutional whales in the entire global financial market?
And that is the mission for us today, and it's a critical piece of analysis for you, the listener. We're going to cut through all the deafening noise of the financial media, which, focuses almost entirely on the pain.
Always.
We're going to meticulously examine both sides of this. The panic sellers, the infamous weak hands executing these forced liquidations, and then the quiet, methodical accumulation by these massive institutional buyers.
Yeah.
And then we're going to lock onto the surprisingly bullish roadmap that analysts in these high-end polls are projecting. We're talking MSTR potentially reaching heights of $700 or even $1,000 by mid-2026.
Assuming, and this is key, that the necessary positive scenario actually unfolds. But we have to hold these two conflicting narratives in our heads at the same time. On one side, you have this genuine systematic fear. It's related to a potential index exclusion, which could trigger billions in mandatory selling, and you've got balance sheet risk from rising debt costs.
Very real risks.
Very real. But on the other side, you have the fundamental, just the cold, hard math of institutions buying a deep discount on a massive leveraged Bitcoin stack.
So our job is to give you the data.
Exactly. Our job is to provide you with the data to determine which of those two forces is currently dominating the long-term trajectory and, setting the stage for the next major move.
Okay, let's unpack this. All right, so let's start with the immediate pain. Because the sheer scale of that 60% drop is what created this whole situation, this investment opportunity or disaster, depending on where you stand.
Right.
When we look at the chart, that drop from 456 down to 179, it just creates this immediate, visceral fear.
Of course.
And it wasn't even a clean fall. Our sources are noting that even though Bitcoin pulled back 30%, MSTR has been lagging that drop. It's being dragged down like a lead anchor, which suggests there are unique company-specific pressures at play here, beyond just the price of BTC.
That analogy of the lead anchor is, it's really accurate because MicroStrategy, despite having a profitable though, secondary software business, is primarily viewed and traded as a highly leveraged, speculative Bitcoin investment vehicle.
It's a BTC proxy, first and foremost.
It is. The moment the underlying asset dips, the stock's embedded leverage just exacerbates the decline on the equity side. It's simple mechanics. But to understand the full 60% drop, we have to look at the specific catalysts that scared off these major institutional and retail players alike.
Absolutely. The first major bombshell that created this huge fear signal, the noise that was just screaming doom all over social media and financial forums, was this looming potential for an MSCI index review.
Ah,
And this
yes.
is not just some theoretical technical jargon, right? This is a serious structural risk that speaks directly to the core identity of the company.
It is. It's a fundamental crisis of classification. So
Yeah.
MSCI, which is one of the world's largest index providers, they manage these huge benchmarks like the MSCI USA index. They're considering booting MSTR.
And there's a deadline on this, isn't there?
There is. The deadline for this potential decision is January 15th, 2026. And the technical, almost bureaucratic reason for the review is that MicroStrategy's business has just dramatically shifted.
From a software company to something else.
Something else entirely. Their index rules dictate that a company has to derive a majority of its value from real business operations, like selling software, in MSTR's original case.
And since Michael Saylor executed this famous pivot, where does that classification stand now?
Well, that's the problem. Currently, over 50% of MicroStrategy's assets are made up of Bitcoin.
So it fails the test.
It fails the test pretty clearly. MSCI's rulebook really struggles with this. They view these massive Bitcoin holdings not as revenue-generating operations, but as a corporate treasury or an investment vehicle.
Like a fund.
Pretty much. From an index standpoint, this creates a capital structure concern. In their eyes, MSTR is no longer a technology firm that happens to hold some BTC. It's a BTC holding company that happens to own a small software firm. And if that classification gets formalized,
They get the boot.
they get the boot.
And the fallout of being excluded from an index like the MSCI USA is, I mean, it's catastrophic for a stock's liquidity, at least in the short term.
Oh, absolutely.
You have these massive passive funds, the index trackers, that manage trillions of dollars. They don't have a choice in the matter. They are mandated to track the index, which means they would be forced to sell.
Right.
That's what we call non-discretionary passive selling pressure. It's not about belief, it's about rules.
And that's exactly why the JP Morgan warning hit the market like a meteor.
That was a big one.
It was. Our sources highlight that JP Morgan analysts estimated the possible financial impact up to $8.8 billion in forced passive selling that could just flood the market.
$8.8 billion.
Just think about the mechanics for a moment. These passive funds, they don't care about the price. They care about compliance. If MSTR leaves the index, they have to liquidate their positions, pushing the stock well below any kind of rational net asset value simply because they have to clear their books.
They just hit the big red sell button.
They do. And that $8.8 billion threat dominated the narrative for weeks, which naturally just amplified that fear signal.
Okay, but I have to push back a little on that. Saylor's not just sitting back and letting this happen, right?
No, he's not.
The sources mention his immediate rebuttal. He came out and said, "We're in talks and it won't hurt us." So why would JP Morgan issue such a harsh, specific warning if the company is actively fighting to maintain its indexing? Is this whole index drama real, or is it just noise being exploited by short sellers?
I think the answer is both. It's both real and it's exploitable. The threat is very real because the index rules are clear. MSTR is, skirting the line at best. But Saylor's response suggests he's deploying his full executive weight to negotiate an exemption or maybe a favorable reclassification. He might be arguing, for example, that the Bitcoin holdings are essential to their long-term stability and therefore are a core part of their treasury strategy, which is typical for any large corporation.
A modern treasury strategy.
Exactly. However, until January 15th, that uncertainty acts as this massive, quantifiable overhang. JP Morgan's warning is so effective precisely because it highlights the mechanical risk. Even if you believe in Saylor, the index computer might just force the sale anyway.
That makes the timeline absolutely essential. Okay, so moving past that external index drama, the second major factor rattling confidence was what our sources called the HODL religion cracking.
Yeah, that was a big deal.
This involves internal financial actions and comments from the executive team that seem to betray the fundamental maximalist belief system that drove MSTR's valuation premium in the first place.
This all centers on the $1.4 billion equity raise. So MicroStrategy went to the market, and they raised a colossal amount of capital by issuing new shares.
Which is, by definition, dilutive to existing shareholders.
Right. And typically, Saylor would immediately use that money to expand the Bitcoin stack. The whole infinite money glitch model relied on the market, always assuming that new capital meant more BTC, which in turn drove the share price up even further.
But this time, the rules changed.
They absolutely did. The crucial detail, and it was noted with shock by sources like FT Alphaville, is that this $1.4 billion was raised not for immediate Bitcoin purchases,
Which everyone expected.
but specifically to hoard USD for 21 months of dividends and for general corporate solvency. It was a massive financial pause button.
Wow.
They created a defensive cash buffer. They prioritized corporate stability and mitigating the risk of their debt covenants over just immediately expanding the stack. And this move, while it was financially prudent, it was ideologically devastating to the aggressive Bitcoin maximalists in their shareholder base.
So the market was just shocked that MicroStrategy was prioritizing cash reserves and, solvency risk mitigation over its core expansionary Bitcoin thesis.
Yeah.
That pause just immediately threw cold water on the most aggressive bulls.
And that cooling effect was magnified by the second point of internal pressure, the last resort hint from the CEO, Fong Li.
Right.
He publicly suggested that if the MicroStrategy net asset value, the MNAV, stays underwater or, trades below 1 for a prolonged period, the company might be forced to sell a portion of its Bitcoin holdings as a last resort.
We should probably pause and just define MNAV simply, because this is the fundamental metric that drives the entire valuation.
Good idea. So think of MNAV as the true liquidation value of the company. It's the total value of all their Bitcoin plus the value of their operating software business minus any outstanding debt.
Okay.
And you take all of that and divide it by the total number of shares. If the stock price trades below that resulting number, it's trading at a discount, or underwater below 1.
Got it.
So the CEO hinting at selling Bitcoin because of that discount sent absolute shockwaves because it implied that the debt and liquidity concerns were so severe they might actually violate the fundamental HODL ideology.
And X-Chatter, formerly Twitter, immediately seized on this. People were calling it the HODL religion cracking.
Of course.
For a company that was built on this unyielding principle of never selling, that statement was perceived as a massive internal betrayal by a lot of retail investors. It suggested that even Michael Saylor's ideology had a financial and regulatory limit, which caused retail shares to just capitulate, hitting those devastating lows around $158.
It was the perfect storm, really. You had external threats from MSCI meeting this internal ideological crisis with the potential BTC sale. And this fear, it translated directly into the technical readout, which signals that the market was pricing in maximum fear, which paradoxically is exactly what the smart money looks for.
That moment of capitulation is so often the signal, isn't it? What did the technical indicators actually show about this level of fear?
Well, if you look at the chart, the fear was extreme. The Relative Strength Index, or RSI, which measures the speed and change of price movements, it plummeted to an oversold reading of 34.
Which is very low for MSTR.
For MSTR, an RSI at 34 is historically a critical buy zone. It signals that the stock has been dumped so fast that the fear level was arguably higher than it was during major corrections in previous cycles. It's a classic sign of just, investor emotional exhaustion.
And the MNAV, that key metric, dipped below 1 for the first time since Q2 of 2024. This is the crucial moment for the deep-pocketed buyers, isn't it?
That's the absolute green light. When the MNAV dips below 1, it means you could buy MSTR stock for less than the proportional value of the Bitcoin it holds.
You're getting the wrapper for free, essentially, and then some.
And then some. In effect, the market was offering Bitcoin exposure at a significant institutional discount. The market was so fearful that it devalued the corporate wrapper below the assets it contained.
And the volume spike just provides the definitive evidence of the panic selling.
Yeah.
Our sources cite volume spiking to what, 42 million shares on December 1st?
42 million, the highest volume the stock had seen in an entire year.
Wow.
And when volume spikes that violently on a downward move, it's not rational selling, it's capitulation. The weak hands were just dumping their shares regardless of the price, often below the underlying MNAV.
They just wanted out.
They wanted out, and that massive volume selling below the asset value is what creates the perfect structural setup for a recovery. It confirms that all the forced emotional sellers exited the door at the exact same time, which clears the path for the next move.
That sets the stage beautifully. Here's where it gets really interesting. Because now we need to look at who was providing the liquidity for that mass exit. So we've identified the fear factors, the structural and ideological shocks. Now let's drill down into who was actually doing the selling during Q3 and Q4 and why our sources are categorizing these actions as, targeted, fear-driven, and often strategically misguided in hindsight.
Right. The Q3 and Q4 selling, it wasn't uniform at all. It was a cocktail of massive institutional trimming, mandatory reallocation, and just raw retail panic.
And the institutional action was the most impactful.
By far, in terms of price movement, it was driven by billions in outflows that just amplified this narrative of a total collapse.
Okay, let's detail those institutional trims, starting with the biggest names in passive investment, BlackRock and Vanguard. The sources note a staggering $5.4 billion net Q3 outflow involving these giants.
That is a colossal movement of capital, and it was widely reported as a major institutional flight. They trimmed their stakes, about 10% of their total holdings, but we have to emphasize they still retained a colossal position of 17.8 million shares combined.
So they trimmed, they didn't exit.
Exactly. And the reported reason wasn't a loss of faith in Bitcoin, but rather a mechanical one, rotation into the newly operational spot Bitcoin ETFs.
Can you explain the difference there? Why would a passive giant move from MSTR to a spot ETF if they both offer BTC exposure?
Sure. The key is efficiency and volatility. MSTR is leveraged, and it's subject to all these specific corporate risks like the MSCI index drama, debt covenants, and the very volatile premium or discount to its NAV.
Right.
A passive fund, on the other hand, seeks the simplest, most efficient exposure to the underlying asset. With direct, regulated access to Bitcoin now available through an ETF, MSTR just loses some of its unique appeal as the only regulated way to get that exposure.
So for a passive fund managing trillions, the ETF route is just cleaner.
It's cleaner, it's less volatile, and it doesn't carry the risk of being booted from a major index.
So the trimming wasn't necessarily an indictment of Saylor's thesis, but it was more of a functional reallocation decision based on the evolution of the market structure. They were swapping a high-risk leverage wrapper for a low-risk pure exposure wrapper.
Precisely. It's a structural shift, not a fundamental conviction sell against the value of the Bitcoin stack. Then you had the more conviction-driven targeted selling, like JP Morgan trimming $134 million in Q3.
And their reason was more specific.
Much more specific. This was explicitly driven by the index exclusion fears and the volatility of Bitcoin pulling the MNAV underwater. They were actively managing risk related to the two major threats we just discussed in Section 1.
And then Fidelity and Capital International also participated in that broader $5.4 billion dump, driven by the same anxieties, index review panic, and just a broader risk-off sentiment concerning these highly leveraged corporate proxies.
Right.
The collective narrative just became institutions are running for the exits.
That narrative, though, is incomplete. Our sources analyze why these massive sales are viewed as potentially misguided or, ironically, bullish for those who maintain their positions. The nature of the selling really dictates the long-term impact.
Okay, so why are sales by giants like Vanguard and BlackRock not a definitive sign of trouble?
Because the majority of that large passive trimming is mandatory reallocation or hedging adjustments based on their internal risk models. When Vanguard trims 10% of a position that still represents $3.2 billion in value, it is not a conviction sell.
It's just portfolio management.
It's portfolio management. It means a portfolio manager adjusted the position size to meet a new internal risk mandate, or they moved capital to the cleaner ETF basket. They were moving risk, not abandoning the idea that Bitcoin is going to climb.
So the sheer volume of selling was enormous, but its intent was largely mechanical. It was responding to index rules or new product availability rather than a genuine rejection of MicroStrategy's future prospects.
Exactly. And furthermore, the timing of the retail panic, the weak hands hitting the bid, is crucial. The sources connect this selling directly back to the overblown reaction to the MSCI drama and CEO Les' hint about selling Bitcoin.
Right.
But the critical timeline detail is that many of the major Q3 trims happened before the company announced the safety net.
The $1.4 billion cash buffer.
Yes. The sellers were panicking about the balance sheet vulnerability and the possibility of a last resort BTC sale. They executed those liquidations before the company secured 2 years of dividend payments and corporate stability in USD.
So they were reacting to old news, essentially.
They were. By raising that cash, the company significantly de-risked its immediate debt obligations and therefore the threat of having to sell BTC. The panic was priced in before the security was announced, meaning those sellers likely liquidated at the lowest possible risk-reward ratio.
They sold solvency risk that was almost immediately mitigated. And that brings us to Mizuho's powerful contrarian view, which really pushes back against this whole institutional desertion narrative.
Mizuho, a very serious analyst firm, still maintains an outperform rating with a specific $484 price target.
Which is a huge jump from here.
It is, and they are extremely bullish precisely because of that $1.4 billion cash wall. Their analysis frames the cash buffer as effectively neutralizing the structural risk of a prolonged BTC winter that might force a Bitcoin fire sale.
So this transforms the narrative from one of instability to one of strategic defense. Mizuho views the dilution from the capital raise as a small price to pay for 21 months of debt security.
It does. They believe the fundamental solvency risk that fueled the panic is now completely off the table for nearly 2 years. And the fact that their target of 484 is higher than the July peak of 456 suggests they believe the company is structurally healthier now than it was when the stock was trading higher.
That's a fascinating take.
They see the recent dip as a massive temporary opportunity created by non-fundamental fears, namely, index worries and market overreaction to what was actually prudent capital management.
And that high volume we saw at the 156 lows, that's where the smart money steps in.
It is classic capitulation. As one of our sources noted, that moment is precisely where the legends buy. When forced sellers liquidate below the true asset value, they are effectively handing over leveraged Bitcoin exposure at a steep discount to sophisticated institutions with long-term conviction.
So the weak hands provided the liquidity.
And now we pivot to the whales who absorbed it. The weak hands sold the fear, and the smart money bought the value.
All right, now we flip the script entirely and focus on the recipients of all that panic selling. While the weak hands were desperately hitting the exit ramp, a massive $500 million plus accumulation frenzy was happening at the exact same time. This is the whale parade, and it provides definitive proof that highly capitalized institutions viewed this 60% drop not as a danger sign, but as a historic buying opportunity.
This section really illustrates the ultimate conviction trade. We are talking about major banks and even sovereign entities making massive, highly specific purchases. Their actions demonstrate this clear belief that the current MSTR price below $200 is just fundamentally mispriced relative to the company's underlying Bitcoin holdings and its renewed balance sheet stability.
Okay, let's detail these major buyers, starting with the National Bank of Canada.
Their Q3 filing was a revelation. It showed a massive $273 million purchase, accumulating 1.47 million shares. And their rationale is foundational to understanding the MSTR thesis for these institutional buyers. They want substantial Bitcoin exposure, but without the regulatory hassle, the direct security risks, and all the internal compliance headaches that come with holding the physical asset or dealing with custody solutions.
It's just easier.
It's so much easier. Buying MSTR is effectively buying a regulated, publicly traded Bitcoin trust with built-in leverage, and they bought it when it was trading at a massive discount.
That's a powerful argument for using MSTR over a spot ETF for certain institutions. The bank isn't interested in the operational risk of cold storage. They just want a price exposure, packaged in a traditional equity format.
Exactly. It's about regulatory convenience and strategic leverage. And they weren't alone in this high-level institutional accumulation. The Swiss National Bank, the central bank of Switzerland, also joined this parade.
The Swiss National Bank. That is huge. What was their motivation for buying $258 million worth of shares?
This signals something much deeper than just a simple equity investment. Central banks often look for assets that serve as macro hedges against inflation or currency debasement, especially in a period of global money printing.
And Bitcoin is seen as digital gold.
Right. So by purchasing MSTR, the Swiss National Bank is using MicroStrategy's leveraged capital structure to amplify its upside bets related to global liquidity and the perceived scarcity of Bitcoin. It transforms MicroStrategy into a central bank proxy for macroeconomic bets, a strategic way to allocate capital to digital scarcity without directly adding BTC to the sovereign balance sheet.
So we have major North American and European financial institutions validating the leverage and the convenience of the MSTR structure. And then we look at active fund managers like Tidal Investments.
Tidal Investments, a $50 billion AUM giant, scooped up $60 million worth, or 351,000 shares. And this was not a passive mandate trade. This was an active position designed to capitalize on that deep discount.
A pure conviction buy.
Pure conviction. Our sources note that Tidal's buy was so strong and immediate that it sparked a sharp 5.8% rally on December 2nd alone. It was signaling to the market that a major asset manager saw MSTR as drastically undervalued. They recognized the discount, and they acted immediately, reinforcing the whole fire sale thesis.
It's important to reiterate the net position of Vanguard here, too.
Yeah.
While we discussed their Q3 trim, which was mechanical, their continuing position really confirms their long-term conviction.
Oh, absolutely. Despite all the trimming noise, Vanguard still holds a colossal $3.2 billion position, representing 17.8 million shares. This is the strongest evidence that their core long-term strategy remains completely intact. They see MicroStrategy as a vital long-term Bitcoin treasury play.
So the trim was just a small adjustment.
Well, Saylor put a substantial personal financial stake into the market to back up his confidence. He personally invested $2.3 million into call options and 23,000 shares.
Wow.
And the specific trade is very telling. He bought 192.5 calls expiring December 12th. This is not some long-term passive HODL investment. This is a very aggressive, short-term bullish bet. It demonstrates that he anticipated an immediate, violent bounce from the lows that he knew were unsustainable.
That kind of insider timing and aggression, it serves as a really powerful signal of immediate confidence.
It does, and Director Patton's HODL Forever mindset, combined with Saylor's options purchases, it just perfectly counters that external panic narrative. When the people running the company are buying the dips aggressively, it tells you the internal belief system remains completely intact.
And this conviction wasn't just limited to named executives and institutions, right? We have significant evidence from the dark pool action.
We do. The dark pools, these are the anonymous trading venues where massive blocks of stock are exchanged away from the public exchanges to minimize price impact. These are often the transactions of the deepest, stealthiest whales.
So what specifically did the dark pool activity reveal during the drop?
It revealed massive, quiet accumulation, specifically $232 million worth of buy orders, totaling 1.24 million shares, were executed right around the 186 closing price.
Incredible.
Furthermore, sources cited a massive $55 million options calls flow, huge bullish bets on the stock rising, all placed during the period of maximum fear. This activity is precisely what we refer to as sneaky longs. While retail was fixated on, minor 130 put options, the overwhelming high capital flow was aggressive, leveraged bets on an imminent rebound.
What's fascinating here is the underlying financial rationale driving all this institutional buying. They aren't buying MicroStrategy for its $50 million software revenue stream.
Not at all.
They are buying the underlying Bitcoin stack at a discount, and they know precisely how to calculate that opportunity.
This is the critical synthesis point. Let's just recap the math. MSTR holds approximately 650,000 Bitcoin coins. Using the context of BTC trading in the low 90,000s, that stack is valued at roughly $58.5 billion.
Right.
So the institutional strategy is mathematically simple. Buy low when MSTR stock is trading at a significant discount, meaning when the MNAV dips below 1, and then sell later when the stock trades at its traditional premium over its assets.
Okay, let's use an analogy to make that memorable. When the MNAV dipped below 1, what was a whale essentially buying?
They were essentially buying a massive, high-quality, leveraged basket of apples. The Bitcoin at, say, a 15% discount, just because the label on the basket, which is the MSTR ticker, was currently covered in mud and scary headlines.
But the apples inside are still good.
The fundamental quality of the asset inside the basket, the 650,000 BTC, had not changed. Institutional capital knows this arbitrage opportunity usually closes very quickly. When the stock price is below the MNAV, the institutional buyer sees an immediate, risk-mitigated way to acquire leveraged Bitcoin exposure cheaper than buying the asset itself.
And the sources confirm that while retail was panicking, sophisticated institutions like the National Bank of Canada were loading up, confirming that the dip represented a historic opportunity given the rock-bottom premium, or in this case, the deep discount.
The massive volume and institutional commitment confirm that this dip was the bottom fishing crew aggressively filling their bags, betting against the retail fear, and setting up the next phase.
The selling was driven by fear and mandates.
And the buying was driven by calculated mathematical conviction.
All right, so now that we've established that the selling was mandate-driven and the buying was high conviction, the big question is, what is the upside potential? If the whales are correct and the 60% collapse was the coiling spring, where does MicroStrategy go next? We must be really clear about the necessary conditions for these highly aggressive price targets to be met.
We absolutely must. We have to emphasize that this entire section operates strictly within the positive scenario framework. If any of these foundational conditions fail to materialize, this roadmap becomes completely invalid.
It's a house of cards without these supports.
It is, but this is the vision that the accumulating whales are betting on.
So what are those foundational requirements for, say, a $700 plus target?
Okay, first and foremost, the underlying asset has to cooperate. Bitcoin has to stabilize and resume its confident climb. We need BTC to hold that $90,000 baseline and convincingly climb toward the 110 to 120K range by Q1 2026.
And that move has to be fueled by something.
It does. It has to be fueled by macro drivers, specifically the anticipation of Federal Reserve interest rate cuts, increasing global liquidity, and sustained massive inflows into the new spot BTC ETFs.
Okay, requirement one, Bitcoin goes up. Second, the biggest structural risk has to be neutralized. The MSCI index exclusion.
Absolutely essential. Saylor's negotiations must succeed. MSCI has to keep MSTR indexed. If that $8.8 billion in forced passive selling is successfully avoided, the biggest short-term overhang just disappears instantly, and it frees the stock to trade purely on the value of its underlying stack.
And finally, number three, corporate stability must be maintained.
The $1.4 billion cash buffer has to hold. This ensures the company maintains operational stability, covers its dividends, and most crucially, removes the last resort threat of having to sell any Bitcoin. If these three conditions hold, the recent dilution is seen merely as fuel for stability, not a fundamental flaw.
Okay, so given those parameters, what does the analyst landscape actually project? We're talking about truly massive upside potential from where we are right now.
The consensus among the analyst community is overwhelmingly bullish. Our sources cite a strong buy consensus from a pool of 15 major firms. The average price target is clustered between 485 and 541. If you enter at the current 179 level, that represents a potential 170 to 200% upside. This shows that the market, even post-crash, believes the fair value of the stock is well above its prior summer peak.
Let's pull out some specific data points to support that consensus.
Sure. So Mizuho, which we know maintains an outperform rating, stands firm at 484. They're citing that cash buffer as the reason no fire sale is needed.
Right.
China Renaissance, another major firm, maintains a buy rating and a 473 target. And even Cantor Fitzgerald, who slashed their price target in response to the volatility, still put their target at 229.
Which is still a pretty nice pop from here.
That still represents a 28% immediate pop from current levels. It confirms that even the most conservative analysts believe MSTR is deeply undervalued right now.
And on the high end, the true bulls are looking for targets that reflect the maximum leverage potential of the MicroStrategy structure, aren't they?
They are. The bar chart high-end models, which assume maximum premium rebuilding, are targeting $705. These models are based on the historical trading patterns of MSTR in previous parabolic BTC cycles, factoring in the leverage that's inherent in their debt-heavy balance sheet.
Okay, let's walk through the technical forecast step by step, starting with the immediate short-term relief rally we can expect, say, next week.
For the immediate period, specifically the December 9th to 15th window, the technical target is $200 to $220. This is based on the stock successfully breaking the key 186 resistance level, which, as we discussed, was the site of significant dark pool accumulation.
And the indicators support this.
They do. The weekly hammer candle, a very strong reversal signal, combined with the volume gap created by the capitulation, suggests an immediate relief rally is due as the risk-reward flips aggressively bullish above that 186 threshold.
Okay, so moving into the crucial end-of-year trading window, what kind of balance are we looking for in the last few weeks of December 2025?
For the end of December, the target escalates significantly to 250 to 280. This move is generally driven by macro shifts, specifically the market beginning to price in a potential Federal Reserve pivot toward rate cuts combined with traditional holiday inflows. Analysts are looking for a technical event they call the unicorn pattern.
We need to define that jargon. What is the unicorn pattern?
The unicorn pattern in this context refers to a sharp, rapid, high-volume recovery following extreme capitulation lows. It eyes a 50% rebound from the absolute bottom.
Okay.
Given the drop from 456 to 156, a 50% recovery would take the stock well past 250. This pattern is predicated on the psychological relief that the selling pressure has fully exhausted itself, allowing the massive institutional demand to finally drive the price higher without resistance.
So a significant move, recovering half of the entire recent collapse in just a matter of weeks.
Right.
But the real explosion, the one that hits the consensus targets, is predicated for Q1 2026.
That's the resurgence phase. The Q1 2026 target is $500 to $600. This is the moment where all those foundational conditions must coalesce. Bitcoin needs to convincingly hit that 110 to 120K mark.
And crucially, the MNAV premium needs to rebuild.
Yes.
Explain how that premium rebuilds.
So, when the market is scared, as it was recently, MSTR trades at a discount, its MNAV is below 1. But when market panic subsides and Bitcoin starts moving up, MicroStrategy traditionally trades at a significant premium, often 10–50% above the value of its underlying Bitcoin stack.
Why does that premium exist?
It exists because of its leverage, its access to capital markets, and its convenience as a regulated proxy. When that premium returns to historical norms, the stock price naturally catapults toward the consensus targets, confirming that the original entry point around 173 was the perfect loading zone for a move toward $500 and beyond as the MNAV normalizes.
And if that momentum continues, hitting the 541 consensus target in Q1 2026, where do the highest end projections take us by the middle of 2026?
The mid-2026 moonshot target ranges from $700 to $1,000. This is the ultimate cycle peak scenario. This projection is based on the assumption that global liquidity expands aggressively, fueling the peak of the current crypto market cycle, and that the ETF synergies, the constant flow of new retail and institutional capital into the ecosystem, drive Bitcoin to all-time highs.
And MSTR just rides that wave, but with leverage.
As the most leveraged, publicly traded vehicle for Bitcoin, it captures the maximum financial upside during this parabolic phase. And if we connect this to the bigger picture, the current 60% dip isn't a spiral. It's the coiling spring for this extreme upside potential, provided the bullish scenario holds true. And the fear created a massive temporary loading zone for the institutions who understand the cycle.
Okay, let's synthesize the core findings of this deep dive. The narrative of MSTR's collapse, driven by that 60% drop, and the looming structural threat of MSCI exclusion, created immense market panic and high-volume capitulation. This was the selling of the weak hands, driven by index mandates and, frankly, overblown solvency fears.
But that panic was immediately and methodically met by conviction buys from institutional whales. We documented over $500 million in accumulation from major entities like the National Bank of Canada and the Swiss National Bank.
All right.
These highly sophisticated players recognized that MSTR, trading below its intrinsic net asset value, was simply too deep of a discount to ignore, a position that was secured by the new $1.4 billion cash safety net, which mitigated the primary solvency risk.
And the roadmap suggests that if the macro conditions align, specifically a climbing BTC price and the avoidance of that $8.8 billion passive sell-off, that fear-driven low sets the stage for a spectacular rebound.
It does.
With strong analyst consensus targets well over 480 and high-end bulls looking at potential moves towards $700 or even $1,000 by mid-2026.
And this raises a really important question that goes beyond just mere price targets and speaks to MicroStrategy's permanent role in the financial ecosystem. We saw that the passive sellers are reallocating their capital to spot BTC ETFs, right? They're seeking lower volatility and pure exposure.
Right.
Simultaneously, the institutional buyers are using MSTR as a highly leveraged, high-risk proxy for the exact same asset.
So the market now offers two very distinct choices for Bitcoin exposure.
Yeah.
Low-risk ETFs or high-leverage MSTR.
Exactly. And my question is this. In a mature crypto market where direct BTC exposure is ubiquitous and regulated, does the intentional volatility of a publicly traded corporate treasury like MSTR become the ultimate preferred high-risk, high-reward trading vehicle, even more so than the underlying asset itself?
It's interesting.
It may evolve from being just a simple proxy to being the dedicated vehicle for extreme leverage speculation on the Bitcoin cycle. And that is the new structural relevance created by this recent collapse and accumulation.
A very compelling thought for you to mull over as you digest the difference between market noise and clear financial signals. We appreciate you taking this deep dive with us today, cutting through the fear and focusing on the underlying conviction.
The signal, in this case, being that extreme fear often presents the greatest opportunities for those who can separate mechanical selling from a loss of fundamental value.
Don't forget to subscribe, and thanks for watching.